Greetings, Forex traders. This is FX with Q. What I'm going to do is I'm going to outline a fundamental fundamental thesis that I really do feel can drive potential trades provided that we get the technicals right. And this fundamental theme that I'm going to be talking about in this video is concerning emerging markets. Now, some commentary over the past few months, over the past few weeks regarding emerging markets has really caught my eye. And it actually has to do with a couple factors. Now, according to Macquarie strategist Victor Schvetz, the biggest risk that is facing investors over the next 12 months is going to be overweight portfolios in emerging markets risk assets. So what we're going to see is a sharp reduction in the dollar supply as the Federal Reserve shrinks its balance sheet and the United States monetary base contracts. Now, what we're going to do is we're going to look at the emerging market index. And this index is unequally weighted. However, it does provide a technical backdrop for the leaders of the emerging market countries. And as you can see, we're up at descending trendline resistance. Moving the conversation back to the fundamental themes, the second, quote, canary or leading indicator concerns liquidity and a dollar shortage that is actually already spreading among emerging markets. So this is a chart prepared by Nedbank, and it shows the Bloomberg, Barclays, EM local, and US dollar denominated debt spreads. So what we can see on the chart is that the highs of 2016 have already been taken out, and the late 2016 lows are now becoming revisited. And this suggests that emerging market funding conditions are in a scenario that is reminiscent to the days where the Chinese stock market bubble of 2015 was in a state of panic. So the big warning that traders need to be considering is that the world, and in particular emerging markets, they're overdosing on US dollar denominated debt. And that's because the dollar as a funding currency to these carrying trades results in 3.5 trillion as opposed to the rest of the world's 10 trillion in debt. So question becomes, how can we as Forex traders take advantage of this fundamental theme in FX spot? Now, a currency such as the dollar Turkish lira, a currency pair, is probably a great place to start. However, currently it being May the 14th, the technicals are looking a bit overbought. Now, of course, if you clone a upward or ascending trend line, and then you extrapolate that, in the hopes of completing an A, B equals CD pattern, then it does show that you have a bit of room left to achieve symmetry since early 2018 has begun. However, I am not advocating an entry into this dollar lira long. So the question now becomes, how do we find a currency pair that we can trade that has technical opportunity to justify our fundamental thesis? If we look at the dollar South African rand, I believe there is a case for a next leg up. For technical signals, I like to trade harmonic patterns, and what we have here is a bullish butterfly. It's actually less than ideal. The retracement on the A to C part of the pattern is only 0.942, usually like to see a bit of a more downward slope to that. But that does compare it to a double top, which is a more simple and thus more widely accepted pattern. One of the advantages of harmonic patterns, such as this butterfly pattern, is that it allows you to create a trade frame that has positive risk reward. So if you put your position on and you are protecting your stops below the support at D, which essentially is about 12.15, and as far as how much reach you want for your profit taking, the upper part of your trade window, that's up to you as a trader. But framing your trade in a way that guarantees a risk reward ratio of 2 or greater is achievable when you have sustained momentum. Now, what I'm going to do is I'm just going to hide the pattern so that I can go to the weekly chart. The weekly chart, looking at the weekly chart and looking at the overall Fibonacci levels of this descending trend line, what we have is we still have room. The 236 level around 1302 is going to be the next area that I believe price action will hit resistance, and a great target actually would be the most recent highs, essentially point A of the pattern. But if you're more ambitious and you don't want to trail your stop and you want a longer time frame for the trade, then you can shoot for the psychological turn at 13 even. So keep that in mind. Keep your trade time frame in mind, and also the risk reward ratios of your trade in mind. Trading fundamentals is always a patience game. It takes sentiment quite some time to react and to notice underlying fundamental themes that have been below the surface and out of the consciousness of market participants. But when the flags come up and when the so-called canaries fall, that is when sentiment begins to shift. So this will conclude the video for this week. Thank you for listening, and I wish you smooth sailing.